The Monetary Policy Committee of the Central Bank of Nigeria began its two-day meeting on Monday, February 23, and is expected to brief the press on the outcome today. Since the last meeting, global risks have risen amid geopolitical tensions and policy uncertainty. However, a weaker US dollar has eased external financing pressures for emerging markets. Domestically, inflation has continued to moderate, supported by exchange rate stability and contained energy costs. Well, joining me for more on this, I have Dr. Omobola Adu, macroeconomist, CSL Stockbrokers Limited. Thank you so much.
With me.
And I also have right here with me Felicia Awolokwe, Team Lead, Meristem Research. Thank you for joining me today.
Thank you for having me.
And finally, Esther Mayowa, Senior Analyst at Cordros Capital. Thank you for joining me today.
Thank you for having me.
All right, so let's begin. Since the last MPC meeting, talk to us about, global economic shifts that have taken the center stage. Let me begin with you, and especially the ones that would definitely shape the CBN's decision today.
I would say since the last MPC meeting that we had in November, we've seen the Fed cut rates in their monetary policy meeting in December. We've seen the Bank of England cut rates as, these economies have to find a balance between inflationary pressures that are still sticky and economic growth that seems to be, lagging a bit. For the UK, it's obvious that if they don't ease financing conditions, it's something that could continue to slow down their pace of growth, particularly for their manufacturing sector. And so they've cut rates since then. And if you look at inflation numbers for the UK, US for January, it has continued to moderate. If not for the, resurgence or the reemergence of tariffs, which could introduce a bit of uncertainty to global price movement, would have said, these economies are well on their path to, the disinflation trend.
All right, interesting. Let's get your thoughts.
Well, I would start with, as you said, we've seen the UK actually ease, the US specifically actually ease interest rates, particularly in December. However, we've seen, geopolitical tension actually increase, and actually much of this has actually stemmed from the US. We've seen assertive foreign policy actions from the U.S. president, tariffs, Venezuela, picking up the president at Venezuela, so many things that have happened actually in the global economy, and that has actually increased, policy uncertainty. And so we've seen that, flight to safe haven, particularly gold prices. We've seen gold prices actually skyrocket. However, we've seen that pivot away from US dollar specifically, and that has because of reduced confidence in the US dollar because of the policy uncertainty we are seeing, particularly from the US, and that has supported capital inflows even into emerging markets and even frontier markets. So in a situation whereby you see when geopolitical tension increase and then you see that capital outflows, but we've seen instead of that, we've seen improved inflows into emerging markets and frontier market, and that has been because of that, loss of confidence even in the US dollar, and that is stemming from US policy uncertainty specifically. So that's what we've seen so far since the MPC meeting in November.
All right, looking at all this, how would they affect the decision of the MPC? Let's begin with you.
Yes, so it's a very delicate act for the MPC heading to this meeting, for the first meeting of the year. So like we mentioned, in the global space, we've seen conditions becoming more accommodative. We've seen number of global central banks beginning to cut interest rates, even in emerging markets also. I think the most important thing right now for the CBN, if you look at previous meetings and how they've been communicating, they're trying to ensure that price stability is key for them, ensuring that prices continue to moderate, as well as having in the back of their minds that you need to start supporting growth. So coming into this meeting, it's going to be the key question between whether they are going to hold interest rates or whether they are going to cut rates for this first meeting of the year.
So what are your expectations? I mean, let's leave expectations aside now. What do you think should be the ideal thing, looking at both domestic and global conditions?
Yes, so I would say that you would have to look at it probably in two perspectives, like what would be the supportive factors for the MPC to decide to hold interest rates and what should support their decision to cut. Now, if we look at it from the hold side of things, a couple of weeks ago, the CBN governor basically indicated concerns around the liquidity environment. They highlighted pre-election spending and how that could impact liquidity in the market and also stoke inflationary pressures. So from that liquidity side of things, you would have reasons to believe that for this first meeting of the year, you just want to probably maintain rates, allow things to continue to develop gradually, and then by the May meeting, you have more context to where the direction of the economy is going, and then you can begin to cut. Now, on the other side of things, we've seen that inflation has come down for about
10
10 consecutive months, right? Coming down just slightly to about 15.1% for January. And then also you see that in the external side of things, the exchange rate has appreciated to close to 1,340 Naira to a US dollar. Over the last couple of weeks, we've even seen cases where the CBN has been in the market just trying to buy dollar liquidity from the system in order to temper the pace of appreciation. So with that in mind, you would believe that, oh, okay, at this point in time, we're a little bit comfortable. We can begin to reduce the policy rate gradually heading into the remaining months of the year. So I think it's going to be a delicate balance, whether right now liquidity is their major concern or they believe that, you know what, we can weather the storm going to this pre-election uncertainties that we expect to happen.
Okay, I'll come back to you, but let me get your thoughts on that.
Yeah, like he has said, there are two, for me,
so either of the two works.
I believe there are two decisions on the table, right? But I'm leaning more towards a cut.
Okay, I like that.
And why I'm saying that is that, you know, there are expectations, apart from what has happened, inflation has moderated, exchange rate has stabilized, and we're even seeing appreciation. And the expectation going forward is that inflation keeps on this, you know, downtrend. And if inflation is expected to keep moderating, then those concerns are somewhat, you know, they could be managed by other measures. There are other liquidity measures that are more effective on liquidity. You can use other monetary tools like the adjustment of the corridor and all that to address liquidity more than the benchmark rate. Keeping the benchmark rate at 27% is quite expensive for the real sector, to be very honest. You know, coming from that angle, we've already seen improvements. Expectation is that this improvement would continue. Yeah, we have concerns about liquidity, but we have other tools that we can use to actually, you know, fix or address that liquidity concern. So, you know, weighing on those factors, I am leaning more towards a cut. But like you mentioned, I won't say a hold is totally off the table, but I'm leaning more towards a cut.
Okay, what about you?
Yeah, I agree with Felicia. I expect them to actually cut rates. Specifically, I think for the MPC, they would look at you know, what inflation has done so far, and even what inflation is going to do. That is, we've seen moderation, you know, persistent moderation in inflation, and then even looking into for subsequent months, we expect inflation to continue moderating. You know, we've seen Naira actually appreciate, which is very, very positive for inflation or disinflation now. So I think, you know, the MPC would look at, you know, these factors, and then coupled with the fact that even though there's, you know, still geopolitical tension, we've seen, you know, the depreciation in a dollar. We've seen, you know, global investors actually pivot from, you know, away from dollar investments to, you know, even investments in high yielding emerging economies. So I think to some extent that is, you know, positive for Nigeria, and I think that the MPC will look at all of these factors, and that would actually, you know, give some room for, you know, gradual moderation in the monetary policy rate. So I expect to see that. So while we expect, you know, monetary policy reduction, I don't expect to see large rate cuts, you know, significant, because of the environment that we are still in. To me, I see it still fragile, you know, considering global economy is still somewhat fragile, and then you know, they still want inflation to moderate even more significantly than what we are seeing. So I expect them to actually cut rates, you know, at a gradual pace, even in their meeting today.
So at a gradual pace, what basis points are we looking at?
Yeah, I'm looking at 50 bips for reduction, and then I do not rule out the fact that they might even do up to 100, but that's my expectation actually.
What about you?
So I would say maybe there's a 60% chance they're likely to hold rates. If they are going to cut, so maybe a 40% chance that we might see a rate cut. And just like has been mentioned rightly, probably going to be between 50 to 100 basis points if they're going to cut rates at this first meeting of the year.
Well, I'm expecting them to cut rate by 100 bips. I mean, inflation is at 15.1, MPR is at 27%. that's a wide gap. Bringing inflation NPR to 26% narrows that gap just slightly. So I think they have leg room, as she has mentioned. We've given a lot of factors that affords them it affords them the opportunity to cut rates. So I think they have the leg room to do as much as 100 bips cuts. Even though it sends signal, it doesn't affect yield on instruments so significantly that maybe it will trigger, capital flight. So I think 100, up to 100. That's
up to 100. Yeah. Let's talk about inflation, because I mean that's like the big thing right here now. Looking at inflation, especially for January, I mean we saw a surprise figure. I was surprised actually. I don't know if you were surprised. So a lot of persons we spoke to were expecting within 18 to 19.05. Even Bloomberg had its own
consensus.
So when you look at all of that, and then we see it as a trend, you see it print as 15.10%, and then we also see deflation, especially when you look at month-on-month numbers. Talk to us. Is that to say that structural? Is this structural? Let me begin with that.
Well, for me, I'd say the 15.1% was sharper than expected. While we believe that prices are actually moderating in the economy, we've seen prices of some items like rice, beans, some other items actually moderate. The stability of the Naira appreciation in some times has even led to price of some import-dependent items to moderate. However, we did not expect that sharp of a drop because of other things. Like you mentioned, there are still structural issues that is affecting our food sector, which is a major component of the CPI. And so even though we are beginning to see, we've been seeing this inflation for a couple of months now, that sharp drop wasn't expected. I certainly wasn't expecting a month-on-month deflation, but I was expecting that, maybe month-on-month pressures would start to ease or continue to ease, because I think it had been easing, but I didn't expect us to just, go into an almost 3% month-on-month deflation.
All right, so does this point to the fact that we shouldn't be worried about inflation anymore? Things are getting better. We should just, cruise along.
Well, I think the most important thing to take away is that inflation is going to continue to moderate. So this is regardless of the rebasing exercise, pre-rebasing, post-rebasing, the underlying fundamentals around inflation direction with that inflation was going to moderate, just on the back of a little bit of structural eases that has been rightly mentioned, and as well as the interest rate direction of the central bank. So the underlying reason is that inflation was always going to moderate. Maybe we're now seeing it at a faster pace than previously expected. If we even look to the coming months, we think that there's even a possibility that inflation could reach single digits by the second half of the year. So there's that strong possibility. But the underlying thing to take away is that pre-rebasing, post-rebasing, inflation was always going to moderate.
Yeah.
I agree with my colleagues here. Actually, whether we see the rebasing or not, or if the inflation figures were actually rebased, the CPI basket are actually rebased or not, the factors that actually drive inflation are actually positive. Like I mentioned about Naira stability, which is a very big factor of inflation in Nigeria. We've seen a strong appreciation. Imagine we had, I think Naira went as high as 1,006 initially in 2024, then now appreciating strongly from that level to about 1.3. That is quite significant for inflation. So whether or not the CPI was rebased, we would have seen that moderation in inflation. And so I think that's actually the key factor, like was mentioned. And then we've also seen PMS prices stable, because that's another pressure point for inflation. So we've seen PMS price, stable and sometimes even moderating, right? And I think those two factors are a very strong factor to actually support further moderation. But we're still expecting that to remain stable even towards the end of the year. And, PMS prices remaining at, stable levels. And then, even other structural factors that, are gradually also easing. We see all of that also supporting, disinflation in coming months. So whether or not the CPI was rebased or not, we expect to see further moderation in inflation, actually.
Well, talking about, our foreign exchange, I'm interested in that, because some persons will tell you that what we're seeing is actually market activities, and it's probably hot money, stuff in that regard. Should we be worried, actually?
Yeah, I could still, not entirely right now. I would say that in as much as there are actually risks in terms of, if there is significant global pressure, that would surely fuel capital outflows. But don't forget that we've seen reserves actually increasing consistently. So that means that even if that pressure comes in, we'll still have that confidence that the CBN is able to intervene in order to manage that volatility. So while we may see some pressure in terms of global, from the global side, that is if there is any shock right now or that significantly affects us, we have, strong reserves that, could help the CBN to actually taper that volatility, and so we'll not see a sharp depreciation. But currently, I think things are actually in favor for a firmer Naira actually, even in the near term. Even in second half of the year, we might likely see the Federal Reserve now resume policy rate cuts even as inflation moderates in the second half of the year, and that is definitely positive. That could also further weaken the dollar and then also encourage capital inflows into Nigeria. So on the base case scenario, we do not actually expect to see that shock, but in the aspect that we see a shock in the global economy specifically, then we have a strong reserves that would moderate that volatility that we may likely see in terms of the Naira actually.
You wanted to say something?
No, so maybe just to also add to what has been mentioned, we also see two, key catalysts for the Naira this year that are likely to crystallize. So we know that over the past 12, 18 months, there has been talks about Nigeria rejoining key emerging market indices, both on the fixed income and the equity side of things. So we believe that if that eventually crystallizes, which we think maybe could possibly happen towards the second half of the year, maybe by March or maybe by June, we think that inflows coming into the fixed income market as well as the equity would also bolster the external reserves and also give the monetary policy central bank more room to continue to intervene and support the currency. So yes, we are very firm and positive on the Naira for this year.
All right, I don't know if you want to say something finally.
Well, I want to play the devil's advocate to say that I agree with everything that has been said, but are the concerns valid?
Okay,
yes.
I guess we have to move to the committee meeting now, the MPC meeting right now, because I hear that very soon they would start the communique.
Account the sustained deceleration in year-on-year headline inflation in January 2026, marking the 11th consecutive month of decline. This downward trajectory in inflation was driven mainly by the continued effects of the contractionary monetary policy, stability in the foreign exchange market, robust capital inflows, and improvement in the balance of payments. The momentum was further reinforced by relative stability in the prices of petroleum products and improved food supply conditions, especially staples. These outcomes have indicated that prior tightening has continued to anchor expectations. The MPC particularly noted the remarkable performance of Nigeria's external sector, evidence supported by higher export earnings and increased remittance inflows. This has contributed to greater stability in the foreign exchange market and bolstered investor confidence. Members also welcomed the newly issued Presidential Executive Order 09, which redirects oil and gas revenues into a federation account. The committee acknowledged the potential impact of this order in improving fiscal revenue and accretion to reserves. Given these improved macroeconomic conditions, the committee believed that a moderate easing was consistent with the prevailing inflation dynamics. Members acknowledged the continued resilience of the banking sector, with most of the key financial soundness indicators remaining within regulatory thresholds. With regards to key financial soundness, he noted that of the 33 banks that have raised additional capital, 20 have met the new minimum capital requirement, reaffirming steady progress towards a more robust and well-capitalized financial system. The MPC reiterated the strategic importance of the recapitalization exercise and urged the bank to ensure its successful completion. This would reinforce financial system resilience and enhance the sector's capacity to support sustainable economic growth. Price and other domestic developments. Headline inflation year-on-year eased to 15.10% in January 2026 from 15.15% in December 2025, reflecting a moderation across both the food and core components. Food inflation declined markedly to 8.89% from 10.84% over the same period, supported by improved domestic food supply, sustained exchange rate stability, and favorable base effect. Similarly, core inflation declined to 17.72% from 18.63%, driven largely by moderation in the average prices of information and communication services. Month-on-month, headline inflation declined to minus 2.88% in January 2026 from 0.54% in the preceding month, indicating a continued softening of price pressures. In terms of output, the Purchasing Managers Index, PMI, stood at 55.7 points in January 2026, reflecting continued expansion in economic activities and likely improvement in output in the fourth quarter of 2025. Gross external reserves rose significantly to $50.45 billion as of February 16, 2026, the highest in 13 years. This provides an import cover of 9.68 months for goods and services. Global developments. Global economic activities are projected to strengthen in 2026, underpinned by progress in trade negotiations, increased investment in artificial intelligence-related technology, and gradual monetary policy easing. Notwithstanding this projection, significant headwinds remain, including rising protectionism, deepening geo-economic fragmentations, and the likely escalation of trade disputes. Global disinflation is anticipated to continue in 2026, driven by the lagged impact of previous monetary policy tightening, further resolution of supply chain disruptions, and improved stability. Near-term inflation is, however, likely to remain above historical averages, constrained by structural rigidities and divergent pace of disinflation across several economies. Outlook. The outlook indicates that the current momentum of domestic disinflation will continue in the near term. This is premised on the lagged impact of previous monetary policy tightening, sustained stability in the foreign exchange market, and improved food supply. However, increased fiscal releases, including election-related spending, could pose upside risks to the outlook. The MPC reaffirmed its commitment to an evidence-based policy framework anchored on the bank's core mandate of ensuring price stability while safeguarding the soundness and resilience of the financial system. The next meeting of the committee is scheduled for Tuesday 19th and Wednesday 20th May 2026. Thank you.
Thank you. That was communique number 161 and the first one for the year 2026, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. Now take questions from members of the press. Please, if you're selected, just your name, your medium, and one question. Thank you.
Good afternoon, Mr. Governor. Good afternoon, everyone. My name is Musa Abubakar, NT. My question is, Nigeria net foreign reserves reportedly reach 40. Now, what are the key drivers behind this build-up, and how sustainable is it over the medium term?
Thank you very much. Just a point of correction there. These aren't net reserves you're quoting, it's the gross reserves. And the gross reserves as at middle of February is about 50.4 billion, which, as I had said in the communique, is the highest figure that we've had in 13 years. Now, we will, in the fullness of time, be saying something in the next few days or so. We'll be breaking down the net reserves figure to give you a better feel for how that has moved over the past few years. So the gross reserves is actually 50.4 billion, and it is the largest that we've had in the past 13 years. Now, your question basically is, what are the key drivers on this, and to what extent is this sustainable? And the answer is, of course, we've seen very positive signals with respect to the way the macros are developing. There have been favorable trade developments. The current account is in healthy surplus. And of course, the non-oil exports have also gone up respectively. It's something I talk about all the time, which is the issue of the diaspora remittances, which again is going up very respectively indeed. Of course, with all this and underpinning all this, quite frankly, is market confidence. Without market confidence, no matter what you do, you will find you will significantly sub-optimize. We, over the period of time, have embarked on a great number of international forums where we've gone out, told our story, we've made promises, ensured that we stuck to those promises, and were as transparent as we could in order to engender positive market sentiment and have economic actors believe in the framework in which we were setting out for the future of our foreign exchange system. So that all, I believe, has paid up quite respectively. Your second question, of course, how sustainable is this? And it's a very good question. How sustainable is this? Now, of course, there will always be risks to any outlook. There'll always be risks to any outlook. We cannot underestimate the potential global shocks that could come our way. Nobody has a crystal ball. We can only project into the future, but who knows what tensions there could be globally that will come in and affect us in a way that we never anticipated. Oil prices, how those oil prices play out, we can only project. Importantly, of course, as pre-election spending, and that also, if not properly contained, can destabilize, the stability we've accomplished. And of course, fiscal deficits, we're in a new year, and I know that that is something that is being looked at very, very, very carefully. And from our side, of course, we've got to make sure that we are consistent with our policy formulation and there are no policy somersaults. Net, my view is that as long as all things being equal, I believe that the trajectory we are on is one that is such that there's every effort being made to diversify our base. And as all those things start to kick in, they can only but add to the situation we're in.
Good afternoon, Mr. Governor. My name is James Major with this day. In January, inflation is to 15.15%. And inflation had been one of the greatest challenges for the central bank. Even when you came, you said of what use is goods if inflation is so high. Today, you have the CBN has reduced NPR. Can we now go to sleep on inflation? Thank you, sir.
Thank you very much. And thank you for reminding me of what I said 2 years ago. And that hasn't changed, to be frank. It hasn't changed. And having said that, caution is our watchword in the central bank. Caution is our watchword in the central bank. We are by nature a conservative group of people. And we have to be that way because we have to do everything possible to protect our economy. And where we see fragilities, we've got to ensure that we're doing the right things to protect our economy and to strengthen our base. Having said all that, we're encouraged, of course, by the fact that, again, going back to what you said, inflation at that time, 34%, we brought it down to where it is, slightly over 15 headline. We're encouraged by that. And we believe that a lot of the measures we have taken, though difficult, though tough in many respects, have begun to pay off. And part of that, obviously, is the monetary tightening. We've had no option but to ensure that we've kept a very, very tight monetary policy. We believe that if we sustain stability in the foreign exchange market, which we have seen in the recent past, that it is important to sustain that. We also believe that it is important that the sort of decreases we're seeing in food inflation should continue like that. We understand the structural rigidities, and we understand that the fiscal is doing everything possible to sort of balance things out so that at the end of the day, the collective will ensure that we continue on a downward disinflation pathway. But having said that, by the way, I must also emphasize that it will take a lot of discipline from all the stakeholders. This is not something that will be central bank alone. All the stakeholders will need to be involved, working collaboratively to ensure that the gains we have achieved are sustained.
Thank you. Mr. Governor, my name is Mark Tibo from Leadership Institute. But the last time you were at Transcorp at the G20 meeting, you observed that digital payment systems pose both risk and benefits and opportunities. Could you please expatiate on that by please identify the salient risk and what the CBN is doing to mitigate those risks? Could you please expatiate on that by please identify the salient risk and what the CBN is doing to mitigate those risks? Thank you.
Okay, thank you very much. A very good question. Thank you very much. I think this particular question is, I must emphasize, is very topical. And not just topical in Nigeria, but topical the world over. Okay, because so many things are happening and are changing in that space. Firstly, we recognize that it is important for the system to benefit from innovation. It's important for the system to benefit from innovation. And we will be doing everything possible to encourage that, to encourage a payment system that, frankly, is good for purpose and eventually does bring out in large numbers a lot of people from poverty. It is known to do that if you get it right. However, we also appreciate the fact that there are risks that go with that. There are risks that go with that, especially risks to financial stability. And it is for that reason that we believe the way forward is to ensure that we have a thoughtful manner of oversighting that particular area and ensuring that we balance out potential risks that go hand in hand with innovation. Within the central bank, we will continue to approach the subject with thoughtful and proportionate measure. We are advancing work already on a very comprehensive framework for digital assets. And that is something that will go through a lot of scrutiny, a lot of thought. We will, conferring with various stakeholders, not just domestically, but internationally, to ensure that at the end of the day, what we get is something that is transparent and can give us long-term resilience. It is very, very important that this happens. So much I know there's a lot of discussion in the internet, out in the open space about digital assets, etc., etc. And I assure you that the approach that the Central Bank of Nigeria is taking to this in ensuring that we are looking purposely and thoughtfully at the future and ensuring that we are managing the risks isn't one that is peculiar to Nigeria. It is one that countries world over are facing. And hopefully we will get it right and will ensure that we come up with something that takes our economy to the position we want it to be. Thank you.
Governor, members of the MPC, good afternoon. Mine is somewhat like a follow-up, but in light of the FinTech report on innovation, inclusion, and integrity, how is the Central Bank of Nigeria strengthening oversight of this, as well as how do you intend to improve coordination between fintechs and the DMBs, deposit money banks, as well as how to tackle the digital fraud risk that we're seeing now, because it's rising. So how is the CBN, are you watching that space, and what are you doing to combat it? Thank you.
Thank you. Thank you for that question, Nancy. Yes. Now, let me go back a bit and even give some context as to why we thought it necessary to come up with the FinTech report. There are over 430 licensed FinTech operators. So to all intents and purposes, they are a systematically important segment. And as you know, many of them are in various geographies. They are already in various geographies. And for us, it is important for us to do what is possible to support their efforts and not wish them away. Many of them are doing a lot of innovative things in various parts, particularly in the African continent. Particularly in the African continent. They are unicorns to some respects. And the least we can do is to put in place the guardrails and to ensure that we have the supervisory capacity to manage them as they go along and ensure that those of them and they all carry our flag when they go internationally, can do so with pride, and that we have given them what it takes to be very successful wherever they go to. So that's part of that. And then secondly also, and if you read that document, you will find out that we put ourselves, we knock our necks out. Because some people that read that document came back to me and said, well, this is a nice document, but how are we sure you can execute it? How are you sure that the execution phase is key? And it is true, very true. And we did that deliberately because we want to put ourselves on the line to ensure that the timelines were put out, it pushes us and other stakeholders to meet those timelines. So it isn't just a nice document that will gather dust and people will forget about. That's not the intention. It isn't. I thought it was important that I mentioned this. We have a
And that is the communique from the 304th MPC meeting. Right there, you were listening to the CBN governor and chairman of the MPC talking about what the decisions are. And I still have right here with me in the studio, Dr. Omobola Adu, macroeconomist, CSL Stockbrokers Limited. Thank you for staying with me.
Thank you very much.
All right, Felicia Awolokpe, team lead, Meristem Research. Thank you.
Thank you for having me.
And finally, Esther Mayowa, senior analyst at Cordros Capital. Thank you so much for staying with us.
Thank you very much for having me.
All right, let me begin with you. What do you make of the decisions? I mean, nothing else was changed. It was just the MPR that was cut by 50%. I think you talked about 50%, while she expected 100%. Okay, let 100 basis points, not percent. Let me begin with you then.
I mean, the cut rate at least. So I think one thing we should take away from today's decision is not just about what they've done. You know, another important thing is what it signals. We can still see from the tone of the conversation that yes, they believe that inflation appears to have been contained. However, the monetary authority is still concerned about liquidity risk that they believe is on the horizon. And although they believe that they have legroom to cut rate, they choose to still remain cautionary about the pace of rate cuts, and that's why we're seeing the 50 bips. But I give it to you, Esther. I expected them to be, you know, a bit bolder than this, but it's understandable, though the concerns about liquidity is still on the horizon, particularly with approaching election that would spur spending activities, campaign-related activities, and all that. That, you know, could have been a major, you know, factor in what the pace of the course would be. Yeah.
304th meeting. Okay, so let me get your thoughts on this.
Yeah, like I mentioned that, you know, we're expecting a 50 bips rate cut, and, you know, we saw that, right? Like I mentioned that their decision would most likely stem from, you know, the moderation in inflation and probably their outlook or what they expect to happen even in the future in terms of inflation. And I think primarily that was what guided their decision to actually reduce the monetary policy rate. But then we saw that it was at actually a cautious pace. And like she mentioned that, you know, they are still concerned. You know, if you look at their outlook for inflation, they actually expect that inflation will continue to moderate, but then they cited risk to that outlook that, you know, that may likely stem from higher fiscal spending, you know, particularly from election spending specifically. So while they are, you know, willing to cut rate, they are still being cautious. And then don't forget that there's still, you know, global uncertainty. So I think that is still another factor they are looking at. So and then, you know, we've seen that pause in monetary policy easing from the US Fed, which may likely now begin in the second half of the year. So I think all of those factors were what they actually looked at, and, you know, they just had to proceed at a cautious space, you know, even in lowering the monetary policy rate. So I think that was what guided their expectation, their decision.
All right, but for me, I would like to ask, how significant is a 50 basis points cut really when you look at the real returns and all of that?
So in terms of this, I think it just reflects what fellow representatives have mentioned, that the CBN and the Monetary Policy Committee are being a little bit more cautious in terms of their views for the economy, maybe over the next couple of months. So 50 basis point reduction, I would say that the market is not surprised by that decision, right? You look at it in terms of what it could mean for the standing deposit facility. It means we just had a moderation from, I think we're close to so it's now, before it was around 22.5, now it's now around 22%. If you compare that to similar yields in the market, so treasury yield is around 18%, OMO yield is close to around 20%. So we say that the moderation is not that strong. Exactly. It just reflects.
It still offers that premium to banks who want to keep their funds with the CBN.
Yeah, so I think it boils down to like what we mentioned at the start and what was also rightly mentioned, that the CBN is more or less concerned about liquidity risks in the economy, especially going in towards the second half of the year, where we think that in terms of redemptions, likely liquidity that's going to be coming into the system is going to be quite substantial. And then you also need to look at it from the foreign investor side of things. We expect that investors that probably got into the market last year when the exchange rate was close to the 1.5 levels, they'll be looking to take a little bit of profit this year. I mean, on the exchange rate alone, they are getting returns of close to 20%, 30% without the returns they are getting on the instruments they invested in. So there's a lot of liquidity risks to look out heading in towards the second half of the year.
All right, again, let's come back to inflation, especially food inflation. Just like he mentioned, or as we already know, we saw it, come down to what single digits inflation figure. Now, talk to us. Can we continue to get food inflation to go downward, or are there specific factors that sort of supported the 8.98%?
I mean, when we speak to inflation figures, I think one thing that is important is to, bring to mind the comparable base. So 8% year on year is, comparing what food inflation, what the CPI, the food index was now compared to what it was in January last year. And you agree with me that there's been a significant change in that sector. January last year, yes, we just came into the period of stabilization for exchange rate. We're just entering into it. The stability was still shaky at best. We would see periods of appreciation and then it depreciates a bit. And then, even the supply in the domestic space was not that robust here. We had not come into harvest, which was a major thing that now improved food supply for us last year. So at the beginning of the year, things were still a little bit dicey. And so if you continue to compare where we are now with where we are at the beginning of last year, we definitely will always look like we're better now. What we should put to mind would be month to month, because that is what actually accounts for progress that we are seeing going from here, right? Are we likely to see that steep food deflation that we saw? It was around 6% in January, month-to-month deflation. Are we likely to continue to see that? I don't think so. Personally, February is, they started Ramadan, there's Lent activities. And during this period, there's less food productivity because particularly the northern part of the country where a bulk of these food productive activities happen, they are more, they are more into the Ramadan fasting. And they are tired easily, they don't do as much work as they would do typically. And so that reduces productivity. And when productivity is curtailed, supply slows, what do? Price comes up. Bear in mind that then we'll be coming into the celebration of, Eid Fitri, where people will try to buy food for festive activities, demand could surge, and so we're likely to see a slowdown in the pace of month-to-month food deflation. But are we likely to still see food year-on-year, food inflation, remain moderate, maybe still single digits, maybe not going to 4%, but at least we are likely to see that in the near term, because if you compare current conditions with the beginning of last year, well, things are definitely better. Last year, we're just entering, import volumes were still what was supporting, supply. We're not seeing significant output from local, producers. But things have significantly changed, particularly with the robust harvest yield that we got last year. So yes, food inflation year on year is still likely to look, moderate.
Do you see insecurity probably affecting that particular figure moving forward?
At this point, insecurity has become part and parcel of the food sector. In fact,
so we should just get used to it, move forward, like there's already a base.
So except we see, other activities, other actions from the fiscal side that could put to rest these issues once and for all, what we just continue to see will be periods of escalation, and then it comes down a bit, but we're not likely to see everything just, disappear over the night. So I think what we should bear in mind, what we should look forward to is, are there further risks that could materialize aside from, the institutional ones, the legacy ones that are currently...
So insecurity is now a legacy.
It's been a legacy issue for more than 3 years now.
Yeah.
So I think, that's why I'm saying, we should maybe not get used to it as if it's a good thing, but we should not be too optimistic as to say, oh, there's going to
Why
be just...
Why should we be optimistic?
Because
there are people at home over
there are structural issues that even if we start seeing actions there's still going to be so much time before all these things, the plans would materialize. So even if we see any significant step now that says, oh, we're fully targeting insecurity in food producing regions, how soon are we to start seeing yields from that? It's going to take time. So I'm saying, for now, let's not get into that overly optimistic role where we start expecting everything to just, disappear overnight. Let us be realistic to say, yes, volumes are improving. We're seeing import volumes, though they are beginning to slow down a bit, but harvest was good. If we don't see any, adverse weather condition that could now reduce yield, if this current insecurity doesn't escalate beyond what it is now, that it affects output again for this year's harvest, then maybe we should expect food prices to remain moderate. But let's not be overly, optimistic that everything is going back down and we'll continue to see maybe 6% month-on-month deflation for food prices, going forward.
Let me come to you. I would like you to speak on energy prices. Really, what's your outlook?
Yes, so at the start of the year, we'd say that the general consensus in terms of energy prices, especially crude oil, maybe focusing on crude oil especially, was that at least crude oil prices was going to moderate this year, maybe averaging close to about $58-60 per barrel. But I mean, over the last, let's say, 2 months, about 2 months, we've seen that oil prices have started to go up close to around $67 per barrel. And that just reflects the, let's say, external risks or risks that are materializing. So at the start of the year, towards the ending of January, we got the US-Venezuela issue. And then slowly, but now within the US-Iran issue, we've seen that Trump initiated a period for diplomatic talks. So at the moment, there is a lot of, let's say, emerging developments that are distorting the outlook around the energy market.
But it feels like, to a very large extent, Nigeria will be favored, irrespective of where it tilts. Is that what it is?
Yes, so I think you would have to look at it from two sides of things. So on the oil side of things, yes, Nigeria would benefit from increasing oil prices. The other thing to look at in terms of fiscal expectations right now, the currency has been appreciating. We've seen the currency now at 1,300, 400 thereabout.
Yes.
So it just means that by the time you are translating your foreign exchange earnings, it might now come a little bit lower just on the back of the appreciation. And it probably speaks to why we're seeing a little bit of interventions by the Apex Bank in terms of trying to just temper the pace at which the currency is appreciating. Because
why do we need to do that? There are so many Nigerians that would want to ask that question. And please let me be the devil's advocate today. Why do we need to, control the way the currency appreciates?
So I mean, you have to put things into context. So if we go back to 2024, thereabout, when the new administration came in, we saw a period when the exchange rate depreciated to around 1.6, 1.7 levels. And then there was this brief period of appreciation when it came down sharply, and then within the next couple of weeks, it shot up again, right? So I think you have to allow things to follow, let's say, a natural sort of state. You don't want, you want a little bit of smoothing. You don't want things to just move abruptly. So when things move abruptly, there, will I say, a sort of shock to the system.
Capital flight and some
and yes, and all those kind of things start to happen.
So, sorry, I want to. So this is why I was trying to play the devil's advocate before we went to watch the MPC's decision, that for the Naira to, appreciate to levels at maybe below 1,211 and to stay there, it requires significant liquidity. Without fundamentals improving, what are the fundamentals? Oil receipts, not just oil production, because like you mentioned, there are factors that could moderate oil receipts even if production dips. Even if production goes up, other factors could still even moderate oil receipts, right? Look at our non-oil exports on the earnings. What are they doing? Those are the fundamentals that can sustainably keep the Naira at rates at that level without draining the external reserves too fast. Because what you see is if we take it to 1,000, like you mentioned, or maybe 1,200, foreign investors want to capitalize their gains, 20% on the table without me lifting a finger. Then I take my money out. I not only reduce supply, I introduce demand pressure, right? And then it puts us back to a position that is worse off where we started from. So there's the need that when we see appreciation that is going to be sustainable, it has to be backed by fundamentals, because the major thing that is keeping the Naira strong right now is the CBN. They are trying their best. The CBN is doing a fantastic job.
So yes, for how long are we going
there's
to
liquidity in the market.
The CBN is doing?
But the CBN has been known to intervene whenever that liquidity pressure wants to come. And that's what is keeping the balance. So the CBN would not want to first off drain itself too fast to bring it to 1,000. Then it doesn't have the capacity to keep it at 1,000 for a long time. And then we'll now go back to 1,600. So the CBN is trying to help us smooth things over. Because I know people have been thinking, why we don't want to take it back to, it went to 1,318. Why did they bring it back to 1,340? so that we don't go from 1318 to 15.
Or 19. Okay, let's close with you. I mean, a lot has been said so far. Let me just get your closing thoughts on them.
Yeah, just like you said, inflation definitely we see that moderating, and then we'll most likely still see, in as much as we are seeing the MPC being cautious, we'll still see that cautious move because of, liquidity concerns, and so we expect to see that, going forward, and then, even the Naira too, we expect that to also remain stable even throughout the year, assuming that there are no, global shocks. So I still think there's still room for that, moderation even in the monetary policy rate. But however, at a very cautious pace, we think that the MPC would continue to watch, how inflation trend downwards, how supply conditions actually improve, and then even how FX also trend, and global conditions specifically right now. So we think that they'll continue to watch that and begin to, adjust monetary policy rates accordingly. So I still think, we are still going to see further rate cuts, but then at a cautious pace, and, still ensuring that there is no excess liquidity that may likely, stoke exchange rate instability specifically, and then inflation at the end of the day. So I think that's what we'll see going forward.
All right, so we've seen 50 bips.
Yeah.
By the end of the year, how many, what do you see?
Our base case scenario is about 300 bips cumulatively for 2026. And I think I still hold that view that we might see a cumulative rate cut of about 300 bips. Like you said, that at some point we may likely reach, inflation may likely reach single-digit levels, which may warrant, a larger rate cuts, right? In as much as they are trying to manage liquidity, you just have to do, some cuts to ensure that you are adjusting policy rates in accordance to how inflation is actually moving. So if we see inflation trend downwards more, then we may see larger rate cuts. But we are seeing about 300 cumulative rate cuts for 2026.
What about you? How many do you see?
Yeah, so we share the same view that in addition to this 50 that we've seen now, we could get another 250 to make it cumulative 300. So the May meeting might be one where we have a much substantial rate cut, just on the back of expectations that by May we could start seeing inflation around the 9-10% levels.
By May?
Yes.
Okay.
I mean, our view too is that, cumulative for the year 200 to 300 bips cuts, and so there's still room for more cuts for the year, because if inflation, keeps on this trend and enters single digit, it gives them more leg room to cut faster. And so if we see 100 bips at any point, and trust me, we're close to 200 to 300 bips cuts by the end of the year.
Absolutely. Thank you so much, ladies and gentlemen. Yeah.
Thank you for having us.
Thank you so much. It's been a wonderful time with all of you. Thank you. And I've been speaking with Dr. Omobola Adu, macroeconomist, CSL Stockbrokers Limited, Felicia Awolokwe, team lead Meristem Research, and Esther Mayowa, senior analyst at Cordros Capital. It's been a wonderful day, I must say. Thank you so much for being a part of this. My name is Perpetua Fasami Peter. See you on the other side. Bye for now.